Okay, well, actually, it's nice that the markets have allowed us to smile. That's the important part.
Do you remember any memory of when you were 19? Lata?
College.
Yeah.
I mean, I had fun, just fun.
What do you think Lata would have done in college? Front bencher, listening to the teachers, and you know.
Yeah, I think so.
That's her definition of fun, maybe.
Shut up.
What about you, Anuj?
No, I have bunked. I mean, not as a rule, but I have bunked. Not gone to movies, maybe, but
When you felt sick?
No, I was a rebel because, you know, both my brothers were rank holders, IIT, IIMs, and also I was a bit of a rebel, backbencher, you know, at 19, I think just taking my bikes to all the parts of Delhi and just roaming around, missing all the classes, frankly speaking, just enjoying like a teenager
that's one
should.
part of Anuj. Anuj is also a very hard worker, and he's not telling us how sincerely he worked as well at his work. I mean, I know some very sincere stories about how Anuj improved his presentation, you know, speaking out in English, smart sentences. Have you ever seen Anuj stutter? He never stutters. His English is always perfect. That comes from hard work, even whether you were a backbencher or not.
So for the large part of the 19 years, we were all here, right, at CNBC TV 18.
And Sonia, we didn't hear your story at 19, and yours is the most recent, right?
Yeah, it is. I don't have to clock back that far into my memory. But no, I mean...
How long was the line behind you?
No, there are some things that can't be said on national television, so better not to talk about that. But yes, we've all been here for a major part of the 19 years here at CNBC TV 18, getting you, you know, the information fastest and the quickest and all the right information. That's important. And having said that, Lata, today could be a good day, you think?
It looks like that. I think the big statement that has come from the Wall Street Journal reporting from Fed sources that they may wait and watch even in the December 18 policy, which is very big news for the markets, which were worrying about the rise in interest rates. And the Huawei overnight news was expected to worsen with some strong words coming from both sides. It's been kind of wait and watch. Neither have made any statements that can lead to brinkmanship. So everyone's waiting to see how this can be disentangled, probably without heightening tensions. So all that's come to the aid of the party. And while you can't say the party began at Wall Street, at least it recovered significantly from almost a 700-point loss to 79-point loss. Asia is actually in the green. Nasdaq itself had celebrated already a bit of green. So I think that we will see a reasonable amount of short covering today.
Also, there is that big event coming up, right? I mean, let's see which way. Yes, exit polls, the results on Monday, so ahead of that. But before that, you know, there are still some negative cues, right? I mean, the Nifty is down for the third straight session. And yesterday, once again, you saw domestic institutions sell for the third straight day in a row. So there was almost 400 crores of selling. Big delivery-based selling across large caps. So ICICI Bank, Infosys, Reliance, all seeing about 300, 400 crores of delivery-based selling. And European markets, don't lose sight of that. The FTSE was down 700 points yesterday, and these markets are at a 2-year low. So, you know, it of course recovered to close down about 200 odd points, but intraday at one point it was under quite a bit of pressure. But we saw a lot of volatility. Even the Dow recovered from that 780-point plunge. Crude prices are down 3%, so let's see which way things go. But Anuj, the big question, ahead of the exit poll results on Monday, will the market favour long positions? Is that the way to look at the trajectory?
Morning, Sonia. You know, the short position which was on since Monday, I think that has run into its logical targets.
And has to be covered.
And has to be covered. So that, I think, is the first thing. And yesterday, while we were closing, we factored in a complete decimation in global market, right? None of that happened. And the market now has cushion of short positions. Yesterday, there were a lot of short positions, especially from the FII side. The issue is that in a market which is so weak, the first gap up is normally sold into. Because, you know, even if you look at the Hang Seng, it's a bit iffy market. So the first gap up might get sold into, but the yesterday low I think is important. Let's see if we, you know, sort of hold that out. In that case, the market's likely to see a decent rally in last hour ahead of exit poll, and the reason is very simple. You know, the bulls would latch on to possible outcome from exit poll and crude oil, and anecdotally, whatever is the outcome of the actual poll, exit polls do tend to favor the BJP. There's a scientific, theory behind it, because, their voters do get overcounted or whatever it is. In the past, you have seen that, the exit poll does favor the BJP. So the market may want to factor that in, and ahead of big events, the markets, especially if it's oversold, does want to take perhaps a contra long. The Bank Nifty, it's very close to the 200-day moving average, 26,000. Remember, we spoke about it on Friday and Monday, that's the possibility. Now you're almost there, give or take 100 to 200 points. So the risk reward does not favor a short in the Bank Nifty now. In fact, my sense is that perhaps from here, the Bank Nifty could lead the market. All depends on whether the gap up today is not aggressively sold into and whether we hold yesterday's low. If we hold yesterday's low, in that case, my sense is the weak shorts who came in yesterday might, just take the market higher from here on.
Okay. Well, another point that we need to note is that the market never reacted to the lower crude prices and the very benign policy from the Reserve Bank, because it was caught in the global whirlwind. Now, as that relaxes, I think the financials could see a decent day.
I agree.
Okay, well, the SGX Nifty for now is indicating that it could be a 60-point bump up, and a lot of Asian markets are holding up in the green, although they are very volatile, must say that. But let's see. For now, there's green on the screen. Let's take a look at what our wise experts have to say as we head into trade this Friday morning. Amit Sachdeva of HSBC says political uncertainty is still an overhang on the market. In addition, he says another round of crude price inflation and global liquidity tightening are some of the key risks which could keep the market volatility at elevated levels. He says their unique bottom-up stock-picking framework identifies companies that are holding their own, those in trouble and those with potential, and they call these structural winners, laggards and trespassers respectively. Amit says their structural winners list includes Avenue Supermarts, Bajaj Finance, Eicher Motors, GAIL, HUL, Infosys, RIL and Titan. Their trespassers list includes Axis Bank, Divi's Labs, IndusInd Bank, and the laggards list includes Colgate, Hero MotoCorp and Kajaria Ceramics. Very well put, I guess.
Absolutely. Nicely written. Let's get you some money market views. Bhaskar Panda of HDFC Bank says uncertainties arising out of Brexit negotiations, fear of escalation of US-China trade war after the arrest of Huawei's CFO, softening global crude prices are some of the major developments overnight. Says last part of yesterday's trading in Indian currency markets was overshadowed by softening oil prices, and today could be a mixed day where the USD-INR pair can trade in a range of 70.40 to 70.60. He adds, opinion poll results will have some impact as and when published.
Okay, all eyes will be on them actually. Bhaskar Panda also speaks about the bond markets. He says in Indian bond markets, the yields nosedived post the RBI's policy announcement. He says a combination of liquidity boosting measures and lower inflation expectations have pushed the 10-year benchmark yield below 7.5%. He says the trend will continue unless there are major reversals in oil prices, and a range of 7.38 to 7.44% for the trading day.
Okay, here's Nigel with the world view.
Well, late last night, the US markets were staring down the barrel. Various concerns did crop up. One was slowing growth. They were worried about crude oil prices that had dipped significantly. And also fears overnight that, in fact, the trade tensions between the United States and China are escalating on the back of a top executive being arrested of a Chinese company. But that wasn't to be. We saw a big recovery from the low point of the day. As you all said, the Dow was up 750 points from the day's low. The reports were that, in fact, maybe the Fed rate hiking will be done at a slower than expected pace, and on the back of that we did see a big recovery. The Nasdaq was in the green. That's because some of those heavyweights in there, they did pretty well. They in fact ended with gains of around 1%. Alphabet, Amazon as well as Netflix. But Apple stock, that was under pressure, ended with a cut of around 1.5%. UBS says that they've seen the weakest purchase intent in the past 5 years odd, and the Dow was underperforming because some of those banking names as well did come in for selling. All of them up for you on the screen. We're looking at the economic data coming out of the United States, and only 179,000 private jobs were added in November. That was lower than the estimated 195,000. It's the first Friday of the month, so we're going to keep an eye out on the crucial jobs report that will come out later today. European markets, though, they ended in the red. All of them ended with cuts of around 3%. Two sectors got hit. One was the auto stocks. The other sector that got whacked yesterday was basic resources, ending with cuts of around 5 to around 6% approximately. We're keeping an eye on the Asian markets, though. Big recovery we saw in the US markets. That's what's reflected today. All Asian markets trading in the green. Two top cues we're always looking at. One is Brent crude prices below $60 per barrel. Some weakness on the US dollar as well. For starters, SGX Nifty is indicating that we're likely to start off in the green with a gain of around 35 to around 40 points. Now it's indicating a 65-point bump up. So let's see whether or not we get that.
You bet. Aankhein taras gaye for that color. Thank you very much, Nigel, for that summary. And actually, we celebrate our birthday with a very important guest as well. Mikso Das of JP Morgan has joined us on the phone line. Good morning, Mikso. You perhaps don't know, today is our 19th birthday. And that's one reason why we've invited you to the party, as it were. But what do you make of the mix of things? We've got the Fed kind of toning down, going by the WSJ report. And there is still a possible brinkmanship over the Huawei affair as well. Where do risk assets look like heading?
Actually, here in Asia, we find that risk assets, the environment for risk assets is actually quite favorable. I think the most important change that we've seen over the last couple of weeks is that from the Fed, where the tone seems to be moving towards a bit more dovish signaling. And we've seen this, right? Investment in the US is showing signs of slowing down, both in terms of residential investment and corporate capex. And inflation break-evens have been trending lower, even faster than the fall in oil prices. Or both of these are kind of signaling that the Fed may have already done enough and needs to wait and see the impacts of its various rate hikes as it plays through the economy. So we could very well see the Fed starting to get a bit more dovish. And what that does for emerging market equities and Asian equities is that it provides a long time window for investors to assess the attractiveness of Asian equities. And by our measures, we do think that earnings in Asia going into next year is going to be quite favorable, and that provides us some opportunity to invest here. Valuations already quite attractive. Business cycle monitors that we have are turning around. So all in all, we do think that markets could trend higher in the first half of next year.
Okay, Mikso, hi, good morning. Thanks for joining us. But which markets do you think the funds would flow into? Because I was just looking at some data from last week. There's almost $2.7 billion of money that came into emerging market funds. Within that, Chinese funds saw $1.2 billion of inflows. Between India and China, do you think a lot more money could go into China this year? Or would it be the reverse of that?
I think at least in the initial stages, which is right now, I do think that the Chinese market is probably better positioned because it's coming off of a much more stronger low. And the movements that we're seeing in terms of trade situation between the US and China, as that improves, that also obviously benefits the Chinese equity market. For now, our favorite positioning in terms of styles is in value. And China, from that perspective, definitely ranks much higher than India. So I would think that in the near term, at least, the Chinese market probably does better, attracts more flows and more attention going into the next several months.
Next several months, okay. So, good morning. So, what is the other big risk factor for India apart from overvaluation?
Apart from some heightened valuations, I do think that there are some minor issues around the RBI's policy making. There are some minor issues if oil prices start to rise again very sharply. But most importantly, from a longer term perspective, I think we are watching the situation in terms of liquidity in the domestic financial system. That's probably going to be the critical driver or critical trigger for long-term investors to start looking at India again.
Well, actually, the Reserve Bank actually announced a giant liquidity promise at its policy earlier this week, about 40,000 crores, that's 400 billion rupees to be pumped in every month, January, February and March. But anyway, be that as it may, what would you like in India? I know there is this overvaluation complaint, but stocks have fallen off as well from that tall 11,800 levels.
Right. So I continue to find the financial sector a reasonable bet in the near term. I do think that we will start to look at growth stocks as well. So the consumer sector, some of the industrial space also looks quite attractive to us.
Okay, all right, Mixer, we'll leave it at that. Thank you so much for joining us and giving us your quick takes. So, emerging markets are looking attractive, but China is better positioned than India. That's the word coming in. Let's get back to some big corporate news. HCL Tech has signed a deal to acquire 7 select IBM software products for a whopping $1.8 billion. Here's more from the chat our colleague Kritika Saxena had with the management.
The strategic rationale is first and foremost, we did IP partnership on 5 of these 7 products in the last 2 years. And we've been able to bring in the product innovation and create the right type of growth. So it gave us a lot of confidence on what we can do on these products. That was the foundational reason why we pursued, and it worked very well with IBM for us to conclude this deal.
Prateek, a quick question to you with respect to the payment and the payout of the deal. So it's $1.8 billion. I saw the details of your release, 1.7 billion roughly in cash and $300 million in debt. Can you clarify if this is correct? And can you give us some more details with respect to if it's a cash consideration, if there's a share swap involved in this as well?
So, Kritika, this is a pure cash deal. The total number, including earnouts, is 1,775, which we are just rounding off to 1.8 billion. Roughly about half of it, about 48% of it, is to be paid at close, which we expect to be by middle of calendar 2019. And the balance half, most of the balance half would be paid after end of 1 year after close.
Okay.
Most of this $1,775 million is going to be internal accruals, financed by internal accruals, except a small amount of about 300 million, which we might raise at close, because some of our funds are locked up in FDs and long-term bonds, etc. That's the only reason why we are raising it. Otherwise, we expect to be cash positive going forward as well.
Okay, so just to clarify, so the $300 million debt you will take at close if required. That may not be a requirement as well if the capital comes in by that point. So that's basically mid-2019 when that debt will be taken, correct?
That's right. It also depends on when we get all the approvals, etc., which is an external factor we can't accurately predict. So depending on the date, we might have to take, or if it gets delayed, we may not need it actually.
What would the impact be on margins, and by when will this impact fall on the company? Can I assume then that only by FY20 first or second quarter will that impact come in?
Yeah, so this is going to be a very profitable stream of revenue and business. So as you have seen, when we published our Mode 3 margins in the last couple of quarters, they have been running at 24-25%. This is going to be, that is EBIT of course, but in EBITDA terms, in cash return terms, it is going to be about 50% of the revenues.
Would you maintain your margin outlook at the current levels in this case, and what would that band be?
See, right now, as I always said, we were good, comfortable in the 19.5 and 20.5. However, this being a large transaction with significantly higher profitability than our standard profitability levels, there are reasons to be a little more optimistic. But I would really wait for the first FY20 guidance. That's the time we will really look at it more comprehensively.
The revenue is going to come in once the deal closes, correct? In that case, what would the exact annual revenue addition be, or quarterly revenue addition be, whatever number that you can share with us?
We expect the revenue run rate, the incremental revenue that we get out of this deal, because as you can appreciate, we have for 5 out of these 7 products, we already have the revenue in the existing revenue stream. On an incremental basis, on a run rate basis, we expect about $650 million per annum. It will be slightly lower in the first year first 12 months after the deal closes, because of transition issues, it will be about $25 million lower. But then the run rate should be 650 going forward.
CVK, the street may argue that it's a large value for acquiring just a portion of IBM's product business, just playing the devil's advocate here. How would you justify that?
I mean, it's a very, financially, it makes a lot of sense. As a business strategy, it gives us strong annuity revenue streams, access to a very large market potential. All of that is very good for HCL across our mode 1, 2, 3 offerings. And even from a multiple revenue and EBITDA multiple, it's quite an attractive deal.
Okay, the deal may be attractive, but there could be some concerns on the street with respect to how much they've paid for this. Remember, they have made a very big bet on the products business, and now with this massive acquisition coming in,